Hello everyone, I'm talking about for chapter 2 financial statement and cash flow. My name is Amal Asgadi, BA 668, my courses. And introduction about for chapter 2 of the financial environment textbook delves into the fundamental concept of financial statement and cash flow. It begins by highlighting the importance of financial statement in providing a comprehensive overview of a company's financial performance and position. The chapter discussed the three primary financial statements: the balance sheet, income statement, and cash flow statement. It explained the purpose of complement of each statement, emphasizing their role in helping stakeholders assess and companies' profitability, solvency, and liquidity. And question one about what is the differences between book value and market value, which should be used for decision making purpose. Book value definition represent the value of the company assessed as reported on its balance sheet. It is calculated by subtracting the company total liability from its total assets. The formula book value equal total assets minus total liability. Characteristics: book value is an accounting measure and reflect its historical costs. It include items like tangible assets, for example, building equipment, and intangible assets, the patent, trademarks, but does not account for factors such as the market value of brand reputation of intellectual property. Market value, for definition, market value, also known as market capitalization, represents the total market worth of a company outstanding share of stock. It is calculated by multiplying the current market price per share by the total number of outstanding shares. The formula market value equal current market price per share times total outstanding shares. Characteristics: market value is a forward-looking measure based on the current market perception of a company future earning potential, growth prospects, and risk. It incorporates factors not reflected in the book value, such as investors' sentiment and market expansion expectation. The decision making about for the book value and more market value, and the choose between book value and market value for decision making purpose depend on the context and the specific nature of the decision. Here are some contradiction. An investment decision use market value, financial health and stability use book value, valuation for acquisition for sell use market value, and risk assessment consider both of them. And question two about for this, what is the difference between accounting income and cash flow? Which do we need to use when make decision? Accounting income definition: accounting income, also known as net income or profit, is the difference between a company's total revenue and total expenses over a specific period. It is calculated using generally accepted accounting principle and GAAP, and include non-cash items such as depreciation and amortization. Formula: the accounting income equal total revenue minus total expenses. Characteristics: and accounting income provided a snapshot of a company profitability during a specific time frame, considering accrual and non-cash items. It is reported on the income statement and reflect the company's financial performance according to accounting rules. The cash flow definition represents the actual cash generated and used by a company over a specific period. It focused on the movement of cash into out of the business, excluding non-cash item and accruals. Cash flow is categorized into operating, investing, and financing activity. The formula cash flow equal cash inflow minus cash outflow. Characteristics and cash flow provide insights into the company liquidity and its ability to meet short-term obligation. It is reported on the cash flow statement, and it captures the cash impact of the operating activity, investment, and financing activity. Decision-making consideration that choose between accounting income and cash flow for decision-making depend on the nature of the decision and the specific information needed. Number one, investment decision. They consider cash flow, financial health, and stability. Consider both of them. And divided payments. Consider cash flow, and credit worthiness, and consider cash flow. Question 3 about what is the differences between the average and marginal tax rate, which should be used when making financial decision. The average tax rate definition. The average tax rate is the total tax paid divided by total income. It represents the overall percentage of income that is paid in the taxes. The formula average tax rate equal total tax paid divided by total income. Characteristics: the average tax rate provides an overview of the overall tax burden, offering a sense of the proportion of income that goes toward taxes on average. The marginal tax rate definition. The marginal tax rate is the rate at which the next additional unit of income would be taxed. They reflect the percentage of additional income that would be paid in taxes. Characteristics: the marginal tax rate is the relevant when considering the impact of the change in income, such as an increase earning or deduction. It helps individual and business understand the tax consequences of incremental changes in income. Decision-making consideration that choose between average and marginal tax rate depends on the specific financial decision and the context of the analysis. The number one, tax planning optimization. The consider marginal tax rate, overall tax burden. Consider average tax rate, budgeting and cash flow management. They consider average tax rate and understanding tax liability. They consider both of them. The question 2, last question, how do we determine a firm cash flow? What are the equation, and where do we find the information? Operating cash flow OCF equation as net income plus non-cash expenses and for example the depreciation plus changes in working capital. Information sources and net income found on the income statement, and non-cash expenses, depreciation, and amortization are typically listed on the income statement. And changes in the working capital analyzed by comparing current and previous periods, balance sheets, and focusing on accounts such as accounts receivable, account payable, and inventory. Okay, investing cash flow ICF equation. ICF capital expenditure CapEx minus proceeds from assets sales. Information sources capital expenditures and CapEx funding the cash flow statement or disclosed in the financial statements. CapEx includes spending on property, plants, equipment, and other long-term assets. Proceeds from asset sales also found in the cash flow statement or disclosed in the financial statement. Okay, financial cash flow, the FCF, the equation FCF, net borrowing, debt issued minus the debt repaid plus divided paid. Information sources: the net borrowing found in the cash flow and statement indicating the net change in the debt over the period. Dividend paid found in the cash flow statement or disclosed in financial statement. Where to find the information? Financial statement key information for calculating cash flow is found in the company's financial statement, including the income statement, balance sheet, and cash flow statement. Annual reports. Companies often provide detailed financial information in their annual reports, including insights into cash flows and financial performance. SEC filing and publicly traded companies in the United States file regular reports with the Securities and Exchange Commission, and such as the annual report. Thank you guys. Bye.